Hello everyone, and welcome back to Asset Informant. Are you looking to add dividend stocks to your portfolio? You may have heard of QYLD, XYLD, and RYLD stocks and are wondering if these are worth investing in. In this video, we will discuss the pros and cons of these stocks and whether or not they should be included in your dividend portfolio. Before we start, please like, comment, and subscribe to stay updated on our future videos. Number 1. QYLD. One of the largest providers of covered call ETFs is Global X ETFs. QYLD is an income-focused ETF that distributes large amounts of income by selling covered calls against its portfolio, which caps most of the upside potential. This ETF holds companies in the NASDAQ 100 index and sells calls on the same index to generate income. The fund held approximately $6.9 billion in assets as of March 2023. Before investing in QYLD, define what your investment goals are and conduct a fair amount of due diligence to determine if QYLD meets your needs. Right now, the ETF's 12-month trailing yield clocks in at 12.8%. QYLD has managed to make monthly distributions for 9 years running. The ETF charges a 0.6% expense ratio, or $60 annually, for $10,000 invested. QYLD has generated an average of $2.36 per share of annual income through its monthly dividend over the previous 9 years. If you're an income investor, then QYLD could be an interesting investment, as its high yield isn't predicated on dividend harvesting and has established a 109-month track record. As far as the company's fundamentals go, QYLD is a well-established business with a strong balance sheet, low debt levels, and healthy cash flows. If you review QYLD's distribution history, which can be found on the Global X site, you will see that since its inception, QYLD has generated $21.44 of dividend income. QYLD has never missed a monthly payment over the previous 109 months and solidified an impressive track record that validates its income generation method. Since QYLD is predicated on selling covered calls, this is a strategy that can work indefinitely, and it has already proven itself throughout difficult economic conditions. Number 2. XYLD. Not all investors like the NASDAQ 100. Some investors may dislike it due to its exclusion of non-NASDAQ listed stocks and financial sector stocks, while they may also dislike it for a high concentration of tech sector and growth stocks. For a more balanced approach to covered call strategies, investors can opt for XYLD, which is basically QYLD but with the S&P 500 as the underlying index. The fund invests at least 80% of its total assets in the securities of the underlying index. The underlying index measures the performance of a hypothetical portfolio that employs a covered call strategy. Just like QYLD, XYLD's strategy is simple. The ETF sells ATM covered calls against 100% of its overall holdings periodically to generate high, sustained monthly income. XYLD has also made monthly distributions for 9 years running. Its 12-month trailing yield currently sits at 13.2%, but keep in mind that this can fluctuate. Additionally, XYLD has a relatively low price-to-earnings ratio, which makes it a viable option for those seeking value in their investments. XYLD has been able to maintain its solid dividend payouts despite the volatile market conditions in recent years, proving to be a dependable source of income for many investors. Overall, XYLD may be an excellent addition to your dividend portfolio if you are seeking a reliable and consistent return. Number 3. RYLD. RYLD is a dividend-paying stock that has been on the market for nearly a decade. Both QYLD and XYLD focus on large-cap stocks due to the nature of their underlying indexes. For an income-focused approach to small-cap investing, investors can pick RYLD, which uses the Russell 2000 index as its underlying asset. Thanks to the higher volatility of small-cap stocks, RYLD currently sports a 12-month trailing yield of 14.3% against the usual 0.6% expense ratio. That being said, RYLD may not be for everyone. Writing call options on high volatility indexes may cap your upside potential if the index runs up but still expose you to significant downside volatility if the index turns south, says Mark Andreos, Associate Portfolio Manager at Regency Wealth Management. RYLD has paid a dividend for the past 8 years, and its dividend yield is currently around 2.4%. The company has grown consistently over the years with impressive returns for investors. By selling covered calls, investors also run the risk of capping the higher upside potential that small cap stocks can potentially deliver. Additionally, RYLD's low volatility makes it a relatively safe stock to invest in. Its track record of success and low risk profile make it an attractive option for any dividend portfolio. When deciding whether or not to add QYLD, XYLD, and RYLD to your dividend portfolio, it is important to consider all of the potential risks and rewards associated with each stock. Consider the overall quality of the company, the size of the dividend payments, and the potential volatility of the stocks before making your final decision. Investing in dividend stocks is a great way to generate passive income, so do your due diligence and make sure you're selecting the right stocks for your portfolio. Thanks for watching. If you'd like to see more content like this, make sure you subscribe to our YouTube channel. See you at the next one.